Good day, fellow investors. We are at the last of our 10 key investment concepts, strategies, soft investment concepts, and one is the time frame when it comes to investing. Great comment here by Eugene. Is 40 years old too late for value investing? And I want to put this a little bit more into an investment framework, also discuss other comments where we have to see what is value, what is investing. We discuss the risk and reward and what you can do in relation to your financial goals. Another comment here from Prasant. Hi Sven, your style of investing speaks the most to me, but what would you suggest for someone with small amount of capital and don't need it for, say, at least 3 to 5 years? Would you still think it's worth looking for irrationality in the markets and stick to value plays with long-term horizon? What's the alternative to bet the little capital you have on some high-risk investments where sooner or later you will lose everything? So value investing is the only alternative, also with shorter investment time frames. If you have to wait 3, 5 or 7 years, you are still okay, because also something that's wrongly understood here is the waiting part. Why don't you buy something you like owning, no matter the waiting and the outlook? I like to be an owner of this, I like the dividends that I get, and that is investing, no matter the time frame. And then this is also a great comment about the long-term compounding chart that we often use, and sometimes I take 40 years, sometimes 10 years. I will use 10 years because it's very difficult to think 40 years to people, but let's do it again. So we have the investor government compounding calculator that's really good, and you can make nice calculations here. Let's say we start with $10,000. Let's say we have a monthly contribution of $500. Let's say we invest for 10 years, estimated interest rate 10%, variance of the interest rate 5%, so we'll have also 5% and 15% calculated annually. And here are the results. So you start with 10,000, you invest 6,000 per year, and with 15% you are to 162,000. If you have just 5%, you are 91,000. This is a significant difference over 10 years. Of course, if we go to 20 years, then the difference starts to really compound. You have 3 times more your money with 15% than with 5%. So 10 years is already significant, 15 years is better, 20 years is even better to allow for the real powers of compounding. And now there are so many questions. If you don't have so much time, what about I need my money in 6 years? Don't invest, start a business. It's really simple. If you need more than 15% returns per year, or your capital is not sufficient, then you have to work harder, make more money, invest more money, or if you want more money, if you really want to get rich, then the way is to start a business, not hoping that your investments will do it for you. Most of my clients have a lot of capital, have a business, they have income, they have cash flows, and they focused on that, and they want to focus on their businesses, and I do the research for them so that they can deploy that money and let it compound over the long term. That's investing. The questions I get with small capital, Sven, could you give me a discount or this or that? The message is really simple. Make more money. Focus on making more money. If you have $10,000 and you want to compound that, and you spend a lot of time doing research, doing this, doing that, it's better that you spend more time on building wealth, building a business, increasing your income, increasing your qualities to make more, and then have more to add on the side with those investments. That's the key perspective also here. I work hard. I prepared this video last evening up till 11. I got up this morning early at 5:30 to film this, and then I'll again some evening edit it and publish it. In the meantime, I will work hard on my business because that's the best source of income I can find. And then the investments will compound over time. Warren Buffett also made his first money with his partnership business, and then he let it compound. That's the core. So do we know the future? No. Can we know what interest rates will be in 25? No. Can we assess the risk and reward of the current long-term outlook? Yes. That's the key. The current perspective of the long-term outlook. So you have to always think about value, what will be there also in 5 years, no matter what, no matter the economy. That's value investing, and that's the risk and reward. Accept the volatility. Yes, stocks can crash 50%, stocks can go up 100, 200%, but if you can't accept the crash 50%, then the answer is simple: don't invest in stocks. If you can accept it, if you can manage it, if you can add income, if you can do this, if you can grow your wealth, then the compounding tool is extremely powerful, and that's what we talk here on this value investing channel. If you enjoyed this, please subscribe, and I'll see you in the next video.